Okay.
of what's gonna happen. Nope, we're just fine. We have a good record here for the minutes, but we're good now. Yes. I'm sorry, folks.
Wonderful.
All right, here we go.
So you have the beginning market value, a little over 20, little under 22 million, 21,972. So you have cash flows, which is obviously a combination of, benefits being paid, money going in and out of investments. So obviously we did a lot more moving in this time period. So it's a little busier, some larger numbers than normal. But you can see the changes implemented there. The mid cap index, which is not a value or growth. It's both effectively core. And then you have the iShares core S&P small cap that was funded as well. So you see the changes that were made there just to kind of simplify things. Non-US, you see the changes there. We reduced some of that overweight to small cap and EM. And then on the next page, on page 5, you can see some of the alternatives in there. Principal real estate, which we will have an update on, and partners group and cash down there. So looking at performance, which is on 6 and 7 and 8. So we kind of break this out more. There's more spacing, so there's more pages used, but we have kind of the composites kind of on their own. So top of the page, obviously through the first 3 months of the year, 3 pretty strong months in a row for equities overall. Fixed income had a good March as well. So for the first 3 months of the year, fund was up about 4%, a little bit more than the composite benchmark of 3.9. Fixed income, you can see was up 1 for the month and positive 0.8 for the quarter versus a negative 0.8 for the ag. Going down the list there, obviously it's very principal heavy for reasons we've long discussed, but you can see on there overall good performance. You have the principal preferred securities on there still, but obviously those are going away. And then Pacific floating rate, that's your non-principal security. You see that was 2.6 for the quarter, and then obviously the past year you've gotten 12.8% from that, so that's been a big help. U.S. equities and non-U.S. equities on page 7. So you can see for the month up 3.5 versus 3.2. You see some dashed lines there for mid cap as well as the iShares. That just means that you didn't yet have a full month of performance yet because we performed these actions during the month of March. So start going forward, you will start to see that populated because you'll get full months of data. For the quarter, it did trail a little bit, 9.1 versus 10. A lot of that being just because we're overweight previously more on small cap. Non-US 2.8 versus 3.0, and for the 3 months trailed 3.1 versus 4.7. Once again, kind of the overweight to the previous overweight to small cap and previous overweight to emerging markets kind of drag that down a little bit. And flipping over, page 8, real estate. You see negative 2.0 for principal on the real estate side of things. Obviously continues to be a challenging environment, but overall looking through time, the time that you've had principal as a real estate investment, it's done a good job compared to the benchmark. Obviously, even if you didn't have the relationship that you have with principal on the annuity side of things, this is, as I've mentioned before, this is someone that we use independent of having to use them to do a very good job. Private equity for this, you see negative 0.6 for the quarter. The index we don't have yet on there, so it's kind of incomplete data at this point for private equity so soon after the quarter. And then 1 year of 5.8. So we saw private equity returns historically muted last year and the year before. Obviously, you had about 3-4 years of really strong private equity returns. So as we hopefully start to see a little more normalization in the private equity world for exits and so forth, that should kind of ease up things on the valuation side of things. But with interest rates still being higher, obviously that all kind of feeds into everything. So that does put a little dampener on private equity returns until those start to come down a little bit. But what obviously the higher rates do benefit is that last item on here, which is cash. You can see for the past year, 5.1% just for sitting in cash. Page 9 is looking at fees on here. So as always, try to keep the same format that we had before, maybe just a little more blue this time. So you can see asset classes, manager, fee schedule, the estimated annual fee based on the asset value, what that expense ratio is, if there's any obviously differences, if there's a fee schedule, which you're on mutual funds. So we don't worry about that. And then the industry median for those types of investments, those types of vehicles, all add up to that first, I used to say blue bar, but there's more blue on here. I guess the darker blue going across the page. So about $87,611 annually for this lineup for your investment managers and your investments there. That's about 38 basis points. And it's just basically just about in line with the industry median of 37 basis points for that. Add in our fee, add in your region's fee, all in down on the bottom, you can see you're paying about $133,611 annually based on the current asset value. Any questions on that part?
What's the remind me about principal, the real estate?
Mhm.
We put in order to get, what are we trying to get down to again?
So when we initially put it in, we put it in
Mhm.
for 500,000.
Mm-hmm.
So obviously we got a couple different things going on here. So you have to get to the current target. And then we also previously kind of talked about maybe a future target.
Right.
So if it goes down, I guess I'll just tell you one thing also, we've already started getting a little bit back.
I saw the 400 on here. I don't know
Yeah,
if that was-
so Jonathan, I think it was 56.
Just under 57,000 on May 1st.
Okay,
So we got 57.
yeah,
Just-
so we're
just for the
starting to at
monthly.
least
Gotcha.
open it up a little bit.
Okay.
So if that 500, we keep that number with current asset values or close enough, that would get that number down to about 8%.
Mhm.
And that was closer to kind of what we were talking about overall. So while that would overshoot your target now, which is I think 10,
Mhm.
we think just kind of let it go and let's see how this plays out. And then that will give you more flexibility if you want to make some longer term moves there. So
If you asked for more, do they give you a percentage of what you asked for, or do they give you?
yes. So
Prorated
is
share.
your other question, what if you were to game the system and ask for more and then people do that?
Yeah, I
We
mean, if
tried.
we said we want 1 million and they give us
Yeah,
About
150,
10%.
Yeah.
Yeah.
then that would be a good deal.
but then the one time that we do that, then they'll say, yep, we're taking it all. Right?
Well, we can always.
But
put
would
it
that,
in.
yeah, would that be the end of the world?
No, I mean, it's they also would have flexibility there, but yeah, there are investors that kind of game that system. So we wouldn't, we'll
This
let
is
you,
being
we'll let
recorded.
you
We
tell
should-
us,
We should maybe game the system,
we'll
I
let
don't-
you, I mean, we'll let you tell
Yeah.
us to do that.
but what are we, oh, you're gonna go over percentages
Yeah,
now?
yeah.
Okay, I'll let you go. over
So
percentages.
exhibit,
Talk
yeah,
about it.
kind of jumping to, got a big picture again, exhibit 2. So the first page is always just obviously your investments within principal and then, you know, the value, what their factor is, and obviously the fixed income has the highest factor. So lower right-hand side of the page, second number in green. So your cushion right now is about 1.2 million. And if you recall, when we kind of looked at moving out more assets, the last meeting, you know, I think we were going to move, you know, just hypothetically, you know, 600,000 or 700,000, which was the preferred.
Mhm.
That really knocked that number down pretty darn low. So kind of uncomfortable levels. So I think we're good right now. Certainly there's still a good cushion, and being that most of it's in fixed income, and obviously there is some in real estate, you're in a good spot. So flipping over, it says January 31st. That is not true at the top. That's just a stale header. Stale header strikes again. So on this page, you can see the market values, and these market values we pulled probably the past week,
As of April 30th.
April 30th.
Okay.
So on here, you can see current values, current mix, target mix, what your plus or minus. And then a couple of things that we highlighted on here and highlighted in red. You know, obviously your monthly benefits, everything, you know, anything kind of cash flows out of the fund, principal is set up to pull from your core fixed income fund. And we talked about this forever. So that is the one that we tend to have to replenish, you know, pretty much every meeting. I went back in time. Jennifer was kind of asking about that today, on email, and went back in time, and, you know, the past couple of years, it's anywhere between 300 to 500,000 each meeting we're having to reallocate to that. So going further down the list, you see principal US property, just for kind of purposes of this discussion. You see the current total was 2,325,431.19. And that includes that 56,000 and change that it's already come out. So this number reflected that reduction on there. So on this page, further down the page, first off, you see Partners Group, which we haven't touched. That's just kind of continue to grow. I think one of the things that we did talk about was, if we do knock down real estate a little bit, maybe that's the place where we can kind of slide additional allocations into. And then Fidelity Cash. So your cash is a number that's higher than it has been. And that's been where the proceeds have gone from the real estate in there. So what we're proposing to do is just send 400,000 back into principal core fixed income, so we can obviously invest that and also use that for benefits. 100,000 coming from cash, so we knock that back down, and then kind of a potpourri of different requests for the 300,000 coming from equities to basically try to get all of them back close to target. So, just a simple rebalancing, pay the bills, replenish, exercise.
Are we distributing that cash?
400,000.
Oh, so
Yeah.
400,000
How
that we're talking
quickly
about.
will we do we need to replenish
Yeah,
our cash?
what was the amount? I think we were close. It's between 100 and 150,000 a month that
Yeah.
goes out. Yeah. So what we'll look forward to in the next month is we'll have some tax collections go in to the tune of about 250 to 300. We do have a significant retirement, probably pulling 200. So we'll call that a wash.
To your
That-
question, though, we're distributing from the principal high core yield, right? Or not the high
Core.
core, the core fixed income is where we distribute from?
Yeah.
Yeah.
I believe so.
So it's moving from we don't
Right.
distribute from the Fidelity cash.
Right, no. Oh, we don't distribute from the Fidelity
That's
cash.
correct. Yeah.
Yeah, so that
I'm
was
sorry, I
created
misunderstood.
when you started a relationship with Regions Bank.
Oh.
And at Regions Bank, you have the Vanguard funds, and then you have the Pacific Bank loans. So on a monthly basis, Regions pulls their fee. Their annual fee was $10,000. So we just keep a little bit in there, so we don't have to each meeting say we need to raise $2,000.
Right, but there's 126 in there right now.
Yes,
correct?
so we're proposing to take 100 of that out.
Gotcha.
Mhm.
Okay.
Yeah.
No, the reason I said I was on,
Yeah.
on a short term, I mean, if we're pulling 150, and we're gonna get 5.2% or whatever you're
Mhm.
gonna make on your cash,
Mhm.
it might be smarter to keep your liquidity money
Mhm.
in the cash account instead of worrying about the fixed income and what it's gonna do.
Right.
I mean, it's been flat this year for the most part.
And
Now that
those are two
through-
different
through
places,
April.
correct?
Mhm.
One's
Yeah.
the Fidelity's at Regions.
Right.
And
Yeah.
there's the principals at Principal.
Yes.
So that was my thought process.
Yeah, and if to officially be within your constraints of your guidelines.
Yeah.
So I think we would probably have another month or so before then you're kind of crosshairs
Well,
with that.
principal doesn't have anything paying that on a guaranteed basis, I assume.
What's the yield in the core fixed income though?
I think the yield to worst is probably, last I saw, like 5.5 maybe. So I mean, it's the trade-off from core to,
Is it a
Cash.
guarantee? Is the core?
no.
I didn't
No,
think
no, no,
so.
That's the yield.
But
the yield to
it's a
worst.
fund, right? It's not
It's a
individual
fund. I mean, it could
bonds,
do-
so
Yeah, there's
No, I
there's
mean,
down months.
It
and
hasn't
there's
done. What I wonder, it's probably close to flat this year, isn't it?
probably negative.
Through April?
Yeah, it's
Because
probably
April
negative.
was not.
Yeah, April is tough. So I
Yeah.
bet it's negative year to date.
Yeah, that was my point.
Mhm.
And I'm not trying to time or do anything like
Yeah.
that.
Sure.
But if we're gonna get if you can get a 5 even get 5%
Mhm.
on a guarantee to free through your cash,
Mhm.
then for your liquidity money over the
Mhm.
short term, say 6 months,
Mhm.
you might as well put it there and not have to worry about, but I don't think we have that option. As usual with principal. It's not it's not you.
I know.
Yeah.
Yeah, I have
Yeah.
some clients that, we have 7.5% in cash. I mean, everybody's got different
Yeah.
goals and risk
Sure.
tolerances and all that. I'm not saying that this is right for you guys, but yeah, I have some that have 7.5, even 10% in cash, and they're happy with knowing that that's 5%, and barring a complete
Well, it's
global
our,
financial
since
meltdown.
we're sending all that money out every month, 150,000 out, it's nice to, if you're gonna keep
Yeah.
liquid, you might as well play the game right now.
Yeah.
Yeah, no, I know the contract. I don't know how old you are, but I assume it was signed before you were born.
1968.
Got me by a few years.
Yeah.
70. I was disco baby, so not quite.
So, yeah, so no, that was my only point, but
Yeah.
we don't have any flexibility on that.
But we could, I guess.
It's not,
We could just say, hey, we'll execute this in June. That,
oh, no, I'm not, you
It
could,
doesn't
no,
matter.
wait, I'm not, that's, now you're timing the equity markets. I'm not saying
Yeah.
that. I'm just saying purely for the stuff you're sending out.
Yeah.
To put it in the fixed income, I'd rather put it in cash. We don't have that option,
but
is what
you
I'm
can't do
saying.
that. Okay.
Right,
clear.
that's what I'm saying. If we're, instead of putting in the fixed income and play that game, I'd say
Mhm.
put it in cash, but we don't have anything to put it in.
Correct.
It's not worth it. So that was my whole
Okay.
point.
Fair.
Okay. But on the other note, I would have no problem saying, put an order in for 1 million.
So
at least.
upside, like a
Because if
million
we,
more, or-
if we get the whole, if they gave us the whole million, we'd have 5+% in real estate still,
yes.
which,
I-
which doesn't bother me at all if we just had 5% in real estate.
So if I recall, and I don't have my materials with me, we just obviously then need to be mindful of how much is pulled out of principal.
Well, if they pull it out of the real estate,
Then
we
some would
could,
have to go to probably fixed income.
we could
It
put
would,
it,
it would help the cushion.
yeah.
To an extent.
That would help, yeah. with the-
Yeah, I mean, then we could decide if we did get that much, let's say they wrote us a check for 500,000. They
Mhm.
wrote us a check, but you know what I mean?
Yeah.
They cash, then we could decide what to do with it.
Yeah.
But at
Yeah,
least you've got
half could
more
go to,
flexibility.
half could go to fixed income, half could go to partners group.
Yeah, I mean, we can see where,
Yeah, see how
At
the
that
math,
time.
see how the math works.
but at least we have flexibility.
Mhm.
So I don't have any problem with that. I don't know if anybody else.
Makes sense to me.
Yeah, I agree.
Okay, so you wanna
We'll have to make a
get
motion.
to a
but
million, or do you want to add 1 million to the existing
I would
do you
say,
wanna get-
I would say your net, your gross would be 1 million total.
gross? Okay, so we'll request whatever the top off is to get to 1 million based on the current, whatever the current queue amount is, which is four.
Whatever, I would just
40.
raise your number that you're requesting to be 1 million.
Okay.
So I'm
would be my
hearing
recommendation.
consensus to increase the request, total request from principal US, what's the
Real estate,
principal US property to 1 million from the current amount of 500.
or whatever the amount is.
And whatever,
Yes,
Yeah.
The initial request was 500.
Okay.
right, but we've gotten some,
Yeah.
Yep.
a little bit, yeah.
Starting.
So we'll call out the request.
Right.
Anybody motion so?
Is
I need
that,
to make the motion or you already? you
is
just
that
made
the
it?
motion?
I can't make motions. I'm not a. voting
Make a
agent.
motion to increase our redemption request with principal US property from 500,000 to $1 million.
My second.
Perfect. Any discussion? All in favor?
Aye.
Aye.
Any opposed? Anybody abstain? All right,
Thank you.
good. All right,
Very good.
and then do we need a motion for you to,
If you could, on
Okay.
this, to be able to fund it so you can pay the bills.
gotcha. Do you wanna? No.
I also make a motion to rebalance equities by 300,000 and move 100,000 of Fidelity cash to principal core fixed income for a total of 400,000 going into principal core fixed income.
I'll second.
Perfect, perfect. Any discussion? All right, all in favor?
Aye.
Any opposed? Any abstentions? Excellent. All right, anything else
That's,
that we need to
that's all the business,
address?
today, yes. When is the actuary coming in? When are they scheduled?
Oh, I did have a, go ahead.
But we haven't asked them to come in,
Okay,
but we do have the report. It turned favorably. It's if we kind of, well, I'll let them to summarize what we heard last year was we had entered the spiral of not being able to fund it over that 20-year period of the life.
Mhm.
And so that ends up, what they do then, instead of using the municipal market debt rate, they use a combined municipal market debt rate with the like a private market debt rate. So we're still inside of that, but just barely. And so it does result in some poor results again, but we'll have them come in and talk to us about it. We had pretty decent liabilities, that rested on the
Yeah.
books last year, and those will continue.
That came on the books or came off the books?
The liabilities and it increased significantly on our
Yeah.
books for the city, because the liability, because the use of that, a different or a higher rate that would be implied if we were to, the pension were to, continue the way it did with the losses that were last year.
Yeah, it's, because I was looking at it and, I mean, if you look at your 10-year return.
Yeah.
Which is, I think, 7.1%.
Mhm.
Which is, a nice return,
Yeah.
but we're still floundering. And you sort of look at our allocation, which I think is a really nice allocation, but the 30% of fixed income really, I mean, you almost want to be 100% aggressive in equities because you have no choice. Now, I'm not saying that's what
Yeah,
we should do,
and
and I'm not
that's-
recommending it, but I mean, you've done, over the last 10 years, we've got a 7% return and we can't, and we're sucking wind on our liabilities.
But it's 7.25%, assumption, so you're behind just
Yeah.
by.
Yeah.
But even
at
that we-
7.1.
Right, but even that, we're still,
Right.
so.
And that's good. Yeah, it'd be interesting. And so that's what those actuarial reports kind of look at. And we did have Jennifer did pose a question, with like, what does this lump sum do? The lump sum distributions, we're talking about somebody retiring in the next couple months with $200,000.
Mhm.
That's gonna come out of the plan, and we have to plan for that. And what does that look like? We just, talked about, it's gonna be in a low risk, something that won't gain. Now, I would ask, you ran the Monte Carlo, scenarios and that,
Mhm.
does that contemplate those kinds of things, or it just looks at this today? It doesn't, the Monte Carlo has trouble looking at like draws or drags, because they're,
So what we do is, we've looked at your kind of historical cash draws, kind of
Okay,
net,
yeah,
net cash
yep.
flow, money in, money out. So that's contemplated, but yeah, like anything that's kind of outside the norm, yeah, it's gonna have blind spots, on that.
You bet.
'cause That's
Okay.
outside the contemplation of it.
so, things to think about. And we'll have the actuary, we'll have Econ come in and maybe talk. Those are really good conversations for what it means.
So, and we just recently, I don't think it's still an ongoing conversation, but actually had a client that was a 7%, actuary increased it to 7.5%. That was the first time I've seen an increase of that much. And for us, I actually, had to raise a little bit of an alarm. That really pushes for us at the risk on things, because obviously fixed income's better, but equities are still in that 7% range. So if you
Yeah.
got fixed income doing 4 or 5 and your equities are gonna get you 7,
You're not gonna
where
get there.
how you gonna get 7.5 north of that? You're gonna be, for us to model it, then we're getting back into international small cap heavyweights and all these different
Right.
things that I would never normally want to do. So that'll be an interesting conversation, see what those
Yeah,
are.
it's just, long term. I assume that if you take a lump sum, it's probably better than taking the annuity for the,
And that's what we were talking today.
I guess it depends how,
again, how long you live
Actuarially,
and all
it
that
should-
kind of stuff.
Yeah,
I get that.
actuarially, it should be 0. That's how they come up with the number, isn't it?
yeah, I think so.
Yeah, well,
But-
that's how they try and calculate it.
But for you, I mean,
Yeah.
that's what the question was, like, as an investment advisor, that's a very
Right.
different conversation than an actuary.
Yeah. it's-
Lending millions of bodies in one and, just
Yeah.
making assumptions.
And it's, then you get into a trap because, I have some clients that have some significant cash needs, and obviously then you got to get rid of anything that's illiquid, because see, that's a whole different issue. And then inherently, you're trying to preserve the short term, so you don't want to get too risky, but you have to get risky to at least have a shot to make it to the long term. So those are
Yeah.
challenging conversations. And, at the end of the day, we kind of then defer to whatever the actuary says of, well, we're saying you got to hit 7. So I was like, okay, well, or 7.5 or whatever that might be. So, okay, we'll at least build that, but it's going to be a potentially rocky ride.
How much do we collect every year to put in
It's
this?
650,000, well, plus about 100 so we'll say 700 to 750 between employee.
And you're sending 1.8 to 2 million out.
Yeah. Yep.
So,
And that's what those cash flow, that went away, didn't it?
That
That
went
cash
away
flow graph.
because we didn't use the full report with all the, that will be,
Yeah.
Summary page.
that
Yeah.
will be
It
back.
does have some cash flow data.
Right.
Yeah, and
No, it's-
and that
but
point,
that's not the-
from that standpoint, what you're
Oh,
talking
equals
about
all of it, yeah.
is
We'll have
that,
that, but just
That's
because of
good.
this
that one
fee.
point in time, if there's cash flow going out, it's always gonna show kind of a negative. It'll continue to get that big old
Yeah,
wide
keep
thing that we've
widening.
seen occur.
Yeah.
big wedge.
Um,
Yeah.
So,
The actuary assumptions
Oh,
are
it is
just
on
what they are.
Yeah,
But
that's what I was saying.
Oh,
yeah, it's on
page-
there. It's on
page
there.
3,
I
okay.
saw it. Yeah. No, it just,
And then we'll have the regular page 2 on the breakup book.
So anything else we could, kind of ask or
What you get to put on the
contemplate with
fridge.
with econ that we'd want to know about? Those are all good questions, great conversations. That's
Yeah,
I mean,
just-
you know. For them, yeah, it's just, what are the options and looking at the cash flows? I said, once we kind of know if they raise your assumed rate of return to 7.5. Or whatever it may be, once again, I'll probably raise my same concerns for that. That's challenging.
And they used to be a lot higher.
Oh, yeah.
Well, it's just unrealistic. I mean, it makes everything look okay, but it's unrealistic. I mean,
I would say their debt assumption is also unrealistic, but
I mean, when a
Fighting
lot of
with
these
actuaries
pensions
is
back
a-
in the eighties, they were
with
projecting
an actuary is
16,
not worth-
17% returns on
you
these
bet. Yeah, yeah, right.
pensions. And they're like, oh yeah, you don't have to fund anything. Yeah, now they're
Just lower that discount rate down to
Yeah.
like 2% and then,
tucked Illinois.
Yeah.
Anyway. All right, is there anything else that anybody would like to bring up? Any new business, old business, new business? Anything? All right, motion to adjourn?
Motion to adjourn.
all right. Thank you, Kent.
Might be out of school here, but I will say that from my vantage point, you guys don't turn on a coat tie. Now, maybe that's the dress code. I don't wanna be that, but if we're the only meeting you come in coat and tie today. Okay, all right. So I'm just telling you, for our purposes, you know, I know you're on TV and all that, but, and I don't wanna talk. But.
I can wear a coat and tie if you want.
Okay, but yeah, if you guys, whatever.
What recording software did you guys change to, out of curiosity?
It's called Paris.
Somewhere where you.
We were at Investor Force. Investor Force was bought out a few years ago by Paris. And they've just been slowly kind of tapping us on the shoulders.
Kent, I'm gonna end this. They're talking investor talk. So.
Okay,
nothing-
sounds
nothing-
good.
Thank you.
So, yeah, we kind of hit the limit in the timeframe.